Imagine checking your investment account one day and seeing a number most people only dream about: $1 million. For many people, becoming a millionaire sounds impossible. They think it requires a huge salary, a successful business, or winning the lottery. But the truth is very different. In reality, thousands of ordinary people in the United States build a $1 million investment portfolio simply by following a few smart financial habits over a long period of time. They are not financial geniuses. They are not taking crazy risks in the stock market. And most of them started with small amounts of money. The secret is consistency, patience, and understanding how money grows over time. In this video, we're going to break down exactly how someone can build a $1 million portfolio step by step, even if they start with a small investment. By the end of this video, you will understand the strategies that long-term investors use to grow their wealth and how you can start building your own $1 million portfolio. Let's start with one of the most powerful forces in finance: time. Time is the biggest advantage you can have when building wealth. Many people believe the key to becoming rich is earning a very high income. But in reality, starting early and investing consistently is often much more powerful than earning a large salary later in life. This is because of compound growth. Compound growth means that your investments start generating returns, and those returns begin generating their own returns as well. Over time, this creates a snowball effect where your money grows faster and faster. For example, imagine someone invests $500 every month into the stock market and earns an average return of around 8% per year. At first, the growth seems slow. In the early years, the account balance might only grow by a few $1,000s. But as time passes, something interesting happens. The returns start becoming larger than the actual money being invested. Eventually, the growth becomes dramatic. After about 30 years of consistent investing, that portfolio could grow to more than $1 million. And this is why starting early matters so much. The earlier you begin investing, the more time your money has to grow. Even small investments can turn into large amounts over time, but time alone is not enough. The next important step is choosing the right investments. Many beginners think investing means picking individual stocks and trying to predict which companies will become the next big success. But even professional investors struggle to consistently pick winning stocks. That's why many financial experts recommend a much simpler approach. Index funds. Index funds are investment funds that track an entire market index, such as the S&P 500. Instead of investing in one company, your money is spread across hundreds of companies. This provides something called diversification. Diversification reduces risk because your portfolio is not dependent on the success of a single company. Historically, broad market index funds have delivered strong long-term returns while keeping costs very low. And this is why many long-term investors build their portfolios using index funds. They are simple, efficient, and designed for long-term growth. But even the best investments won't work if you don't stay consistent. Consistency is one of the most important habits when building a $1 million portfolio. The stock market goes through ups and downs. Some years the market performs very well, while other years it may decline. Many new investors panic during market downturns and sell their investments. Unfortunately, this is one of the biggest mistakes people make. Successful investors understand that market volatility is normal. Instead of trying to time the market, they continue investing regularly, regardless of short-term fluctuations. This strategy is often called dollar cost averaging. With dollar cost averaging, you invest a fixed amount of money at regular intervals. Sometimes you buy when prices are high. Sometimes you buy when prices are low. But over time, this strategy helps smooth out market fluctuations and keeps your investment plan on track. Another important strategy for building wealth is increasing your investments as your income grows. Many people start with small monthly contributions, maybe $200, maybe $300. But as their careers progress and their income increases, they gradually increase the amount they invest. Even small increases can have a powerful impact over time. For example, increasing your monthly investment by just $100 can add hundreds of thousands of dollars to your portfolio over several decades. This is why many investors make it a habit to increase their contributions every time they receive a salary raise. Over time, these small adjustments significantly accelerate the journey toward a $1 million portfolio. Another powerful tool for building wealth is using tax-advantaged investment accounts. In the United States, retirement accounts such as 401ks and IRAs offer significant tax benefits that help investors grow their wealth faster. For example, many employers offer matching contributions in 401k plans. This means your employer may contribute additional money to your retirement account simply because you are investing. This is essentially free money that can dramatically increase your portfolio over time. Tax-advantaged accounts also allow investments to grow without being taxed every year, which helps compound growth work more efficiently. But while investing strategies are important, avoiding mistakes is equally important. One of the biggest mistakes investors make is reacting emotionally to market movements. When the market crashes, fear spreads quickly. People start selling their investments because they believe things will continue getting worse. But historically, markets have always recovered over time. Investors who remain patient during downturns are often rewarded when markets recover and continue growing. Another common mistake is trying to get rich quickly. Some people chase risky investments, hoping to double or triple their money overnight. While these strategies may sometimes work, they often lead to significant losses. Building a $1 million portfolio is usually not about taking extreme risks. It is about making steady, disciplined financial decisions over a long period of time. And that is what separates successful investors from everyone else. They stay focused on the long-term goal. They invest consistently, they avoid emotional decisions, and they allow time and compound growth to do the heavy lifting. So when you break it down, building a $1 million portfolio is not magic. It comes down to a few simple principles. Start investing as early as possible. Invest consistently over time. Choose diversified investments such as index funds. Increase your investments as your income grows. And stay patient during market ups and downs. If you follow these habits over the long term, reaching a $1 million portfolio becomes much more realistic than most people think. And the most important step is simply getting started. Because every year you delay investing is another year your money loses the opportunity to grow. The earlier you start, the easier the journey becomes. So whether you're investing $50 a month or $500 a month, the key is to begin and stay consistent. Over time, those small investments can turn into something incredibly powerful. And one day, you might open your investment account and see a number that once seemed impossible: $1 million.